I want to thank everybody for being on with us today and for giving us part of your Wednesday to talk about gift planning, the perfect partner to your retirement plan. I want to give some kudos to Hannah Jackson, who's on the phone with me, because these slides that you're looking at today are all virtue of her creativity. So Hannah, thank you for that. And it's my job just to walk you through these, hopefully give you some content that you didn't know before today. And again, just ask me questions at the end of this call. Happy to go through any of the specific questions with you as well. But thanks for joining us. It's neat to do a call like this with people in the church because most of you understand the biblical definition of stewardship, which means essentially that God owns everything. It's all God's. We're just stewards of it. And when we check out of this life, we really don't take anything with us other than our love and hope in Jesus Christ. Everything else stays behind. Mark Batterson has a wonderful quote that it's easy to act like a Christian. It's much harder to respond like one. And gift planning in context of the church is often about responding to our God-given gift to give back. And it's a great opportunity. So this is a great topic. It's a topic that prior webinar attendees have asked for more detail on. So we'll go through this today and see what you think. What we're going to talk about today is essentially identifying your goals, just like you would if you've thought about retiring or retired or had to set a plan to do so. Generally, you have to have goals established. When a planner sits down and works for you, or does a plan for you, they're going to want to know your goals. So similar to this, what are your charitable priorities? Where do you want to focus? Then secondly, you would establish a giving structure around that. Again, part of the plan. What's the structure? What are the assets you're going to give? What are the tax implications of that? And who are you going to give that to? The third section is implementing and refining the plan. It's not a set it and forget it. You have to make tweaks to it. You have to make adjustments as time and your situation change things. Exploring giving tools, we're going to go through some specific tools that you can use as part of a giving plan. It doesn't mean that they're the solution for everybody. It doesn't mean necessarily they're your solution. They're just solutions that are more globally used and that we see here at Moravian Ministries Foundation. And then, of course, at the end, we'll leave time for questions. So starting out, identifying your goals. This slide has a lot of different priority areas. This is a Wordle before Wordle was really cool. You can put this in software, different priorities, give different weights to them, and it will spit out, okay, here is what you said. And of course, the bigger words are the ones that you mentioned more times or that you gave higher priority. This would look very different depending on each individual that does it. I worked with a couple one time that created a donor advised fund, and they had a very specific goal of funding educational scholarships for a group of girls at a school in South Africa. Very, very specific. Some people are very pointed at what their goals are, especially in the charitable space. Moravians are often that way. It's rare that I sit down with a Moravian to talk about a plan that they don't know specifically what they want to give to. So usually this is an easy part in my job to work with Moravians on, but sometimes it's a little harder. Maybe sometimes you don't know what you want to do and what you want to give to. Finding your focus, organizations, interest areas. Sometimes people do not have specific organizations, but they know, hey, I want to give my money to relieve hunger or to deal with sickness or to relieve childhood poverty. Whatever your issue is, again, very, very specific. Other people have organizations. What is that focus? I find it very eye-opening when you do this with an individual or a couple and you walk through this exercise and they tell you what they think their goal is, and then you look at what they've actually given money to, where they put their time, where they put their interests, organizations they follow, get materials from. Look at their goal, look at the actual story. Often they don't match. So what you want to do as this process is, if you're saying this is your goal, then try to align your giving, try to align your time, talents testimony toward that effort versus everything else. There's a lot of noise in our world, especially right now. There's no exception to that. So sometimes just honing your focus and setting that up. Involving your family, this is also different. Some people want to include their family in philanthropy, include their family in faith giving. How do you do that? There's various different ways to do that. We'll see that in some of the tools today. Other people don't want to include family, or maybe they feel like their family is well taken care of, or they do that on their own. Again, very, very specific. This is about your goals. Identify what you want to do. Is legacy planning part of what's important to you? Do you want your great grandchildren to know what you were about, what was important to you in life? Then that may be a focus, including your family, setting that up from the beginning. If not, it's not an issue, and you can move on without including those others. The next slide, establish your giving structure. This takes probably the most work when people talk about a giving plan. What do you use to facilitate the plan? What assets will you use? That's extremely important. The tax code creates a lot of opportunities. It also creates a lot of challenges. So one of the things you want to think of, particularly if you have children, is what assets do you use for your giving versus what assets do you leave for future generations. Part of the challenge when you talk about something like an individual retirement account, an IRA, if you leave that to your children have to pay tax on that money. They have to fully withdraw the money in 10 years and pay income tax on the full balance of that, because that's the law now. If you leave that asset to charity, no tax. So maybe you have life insurance or other assets that could go to the children, and use those more tax punitive assets to do your philanthropy. It helps to look through this, give some thought to it, include your accountant, your attorney, others that are familiar with your situation as you establish your giving structure and think about what assets you can use. Certainly there are more assets, or certain assets are more advantageous to give to charity than others, but to give some thought through that. Integrating with your taxes and current income, sometimes that's a timing thing. When does it make the most sense to give this money? We want to encourage as many gifts as we can during life, but situations change, things change as you age, they change just sheer life coming at you. There's a lot of different things that can change that. So again, do you do the gifting through a will, or do you do it while you're alive? Again, we encourage people to always do some of it while they're living so they can enjoy the benefits of seeing their resources used for ministry. Taxes, it's rare in our context that we deal with people with a taxable estate anymore. You've probably read about this, seen this in the news, but next year, with the tax changes this year, married couples can shield virtually $30 million from estate tax. So there's not a lot of people that have a taxable estate. If you know people that have taxable estates, refer them to Moravian Ministries Foundation. We're happy to try to help them. And we help anybody regardless of estate size. But again, taxes, in terms of taxes on your estate, what you leave behind, are rarely an issue that we deal with or something we have to worry with. But there are other taxes, income tax, capital gains tax. How do you minimize the impact of that with your giving? Which organizations can accomplish what you want to do? Leadership matters. Leadership of organizations matter. Just because you want to do something doesn't mean the organization you're giving your money to can actually do that or fulfill that mission. So that requires some thought, requires some research sometimes, requires conversations with the organization. You need to have a comfort level that they can actually do what you want them to do with your money, that they can fulfill your goal, make it a reality. If the leader leaves, something changes, the organization certainly could change, but many organizations are mature enough to handle that and move on. The core mission's not going to vary, but that's not the case with all organizations. So something to think about. Leads us into contingencies. Talk to people all the time that are worried, hey, will this organization be around forever? Maybe my church, hey, we're only having 10, 15, 20 people in worship on Sunday morning. What's the future of that look like? You know, it might not be an issue for your lifetime, but it may be an issue for the next generation. You need to have contingencies in place as the world changes and situations change that can still make your gifts, goals, dreams come true with the assets you leave behind versus leaving it for specific calls that may not last a long number of years. There's tools to help. We're going to go through some of those tools later, so I'm going to gloss over that bullet point for now. Implementing and refining your plan. Again, I mentioned this early. It's not a set it and forget it. You've got to try to plan for the what ifs of the world as best you can. It's your money to be a steward of, so you need to drive the decisions of what happens now with that, what happens in the future with it. Timing and frequency of your giving. It's a great concept called bunching now, where you can give a lot in one year, itemize your taxes, and then take the standard deduction in other years while you utilize those gifts. We'll reference that again when we talk about some of the tools later. But again, timing sometimes matters. Sometimes you have a windfall of resources in one year you don't have every year. You need help trying to facilitate some charitable giving to maybe get you a deduction, may just meet some goals with the ministries that are important to you. Again, it's very, very specific to your situation. How do you want your giving used? Again, that's your decision. It's not only your decision now, it's your decision after you're gone, and how can you ensure your wishes are fulfilled. Honing the plan, again, don't set it and forget it. This is much a message for every charity as it is for individuals. Most estate giving in this country is solidified in the last 5 years of life. Most of the people making those plans actually change their plans in the last 5 years of life. Russell James gives a lot of data on that. And why do they change it? Generally, it's because people get mad at an organization. People do not feel loved in an organization. They don't feel close to it anymore. So they make changes. It's very important to keep things up to date, keep relationships up to date, make sure people are kept informed, and make sure you're getting the information you need as a donor to be aware of what the organization is doing, how they're using gifts, how they can fulfill your mission and carry that into the future. So all of that's things to watch, keep eyes on as your plan develops and goes into the future. Tools to consider. So we're going to talk about 3 today. 3 tools that we're seeing used more and more. These are the primary gifts in terms of structured philanthropy Moravian Ministries Foundation sees, and it matches pretty much industry trends across the United States. Donor advised funds are used a lot. They're easy to use, easy to set up. Anybody can do it, individuals, organizations, etc. So it makes it, the ease of it makes it an easy tool to use. Named funds. People are often concerned of what happens when I'm gone. Is there a trustee there to manage? Is there some sort of fiduciary relationship? Is there an endowment established, a fund agreement that drives what happens? Versus I just give the charity money and have to trust that they do the right thing with it forever. So we're seeing more use of named funds as well. The third category, charitable trust, particularly charitable remainder trust. We're seeing them used more and more as a reciprocal of those retirement assets for children. You can set the trust up with your children as the beneficiary, and then at the end of the children's lives, the charities get the benefit of what's left in that trust vehicle. So we'll go through all 3 of these. I'll give you some examples of Moravians that have used these. Some names, some will have to protect the innocent as I share the examples. We'll talk about each one of these a little more in depth. So donor advised funds, this slide shows you a chart of how a donor advised fund works. You make a gift, you take a tax deduction in the year you make the gift. The money goes to the sponsoring charity that creates a segregated account named what you want it to be named, that then you retain the privilege to make grant recommendations from over your lifetime, over a term of years. If you never give anything away out of that fund, right now the law says that's okay. You've taken your charitable deduction, that's a completed gift. You just need to make plans for what happens to that when you're gone, so it doesn't just sit there in a fund. Generally, these are very, very easy to establish. maximum charitable benefits. You see that on the slide. That's why bunching is used. You can get a maximum tax deduction now. So again, whatever the highest charitable income tax deduction is, that's allowed to donor advised fund donors. So many people have a windfall in one year, they'll fund a donor advised fund. They use that for their charitable gifting for years to come. Some often don't have to refund it. Some refund it every year. It insulates you as a donor from a lot of solicitations from individual people, individual groups. You can just say, hey, I'll make a recommendation to my donor advised fund. That shields you from all those people, all those asks for individual donations. Simple to establish. It's literally a set of pre-printed forms. You just sign your name. You have some decision points in that. What do you want to name the account? If you want to remain anonymous, more so with your giving, you may want to name it something that doesn't have your name in it. For example, don't use trust, don't use foundation in the name. Other than that, you can name it pretty much anything you want to. Most people use their own names or their family name to name a donor advised fund. But very simple to establish. You also have to think about what happens at the end of life. Do you transition it to additional advisors, or does it fund another type, like a named fund, an endowment, something like that, or if you just pay the balance out to the charities you choose. You get to pick the investments with a donor advised fund. With Moravian Ministries Foundation, you would pick the pool that the fund is invested in. You get to decide the asset allocation. Again, it's recognition that these are assets that you've stewarded, so you get to have a little bit of control with that. You retain the privilege to make grant recommendations. I always say it that way. It's a privilege, not a right. You can make a grant recommendation. You can say, hey, Chris, we want to pay this organization that's funding Al-Qaeda. Our foundation would not honor that grant request, and that is our right. We can deny any grant request. Now, obviously, there's political fallout from that, because you're probably going to say, well, you've made me mad. We're not going to give you more money. So if at all possible, we try to honor what our donors request, but we don't have to. There's been some court cases litigated over this matter, and the charities have won in those cases, because what the IRS and the judicial system say is, hey, you made a completed gift. You got your tax deduction. That was your benefit. Most of our grants go to churches and other Moravian ministries, so obviously we honor those. Organizations that we're not familiar with, we have to do more research on. And with our foundation, at least 50% of the grants have to go to something Moravian. But again, most of the time, that's 100% with the organizations we deal with. So you get that privilege to make grant recommendations. There's low administrative responsibility for you. Think of all the checks people often write to charities. The foundation's having to write those checks for you. You're simply doing a grant request. It's a pretty easy process. You don't have to administratively keep up with that. You don't have to follow up to make sure the charity got it or how they use the money. That's all on our foundation to do that. And we love doing that and do that for several of these accounts. You get to name successor grant advisors. So we talked earlier on one of the very first slides about using your family, including your family in this. This is a great opportunity to do that. Maybe you want your children to be involved or grandchildren making grants. You can pull them in even during life, but you definitely can name them when you enter the Lord's more immediate presence to advise on the pool of money that's left. You also can name a trust, a named fund, or just pay the money outright to a named charity. Often when we start a donor advised fund, people don't want to decide that right out of the gate. And that's something that you can decide and maybe next year change. It's okay. It's totally within your right to do that. Again, administratively, these are very easy to establish, very easy to maintain, change things, to really make sure it's about visiting that plan. Is it still what you want? Is it working the way you want it to? And are you getting the benefit of it that you thought you would get day one? So examples of donor advised funds, who should consider one? Really anybody could consider one of these at any given level. There's nothing that you don't have to have mega bucks to be able to establish a donor advised fund. It's a way to organize your giving in a structured way and also track more so, we're doing that for you, who you're giving to, how that giving's working. Really good uses of a donor advised fund are the busy executive that's working, getting a lot of solicitations, not having to deal with that. They'll do all of their giving through the donor advised fund. It's easy from a tax standpoint because you make one donation, it's one deduction, and you don't have to keep up with these individual receipts. You don't have to keep up with individual donations. Anyone pulling others into giving would think about a donor advised fund. Maybe you want to start one with your coworkers. Maybe you want to start one with your family, involving others in giving, involving others in the ministries and charities that are important to you. Donor advised funds, easy to do that with. Certainly an opportunity for somebody that has an influx of cash. Maybe they've just won the lottery, or they've had somebody, they've got an inheritance, they have a sudden influx of cash. You may want to park that money for your charitable giving, and you'll have it for years to come. You can give it away $100 at a time over many, many years. And anybody with a goal, anybody that has a philanthropic or charitable goal, wanting to give away money in an organized way, a donor advised fund is a great tool for you to use. Certainly MMFA examples, the very first account that I worked on when I came to the foundation was a donor advised fund, and it was a gentleman and his wife up in the Lehigh Valley area of Pennsylvania who donated some farmland. They had 3 children, and but none of them wanted the family farm. None of them wanted any part of it. And this gentleman was, strangely enough, he and his wife were not Moravian, but he had gone to Moravian college, graduated from the seminary there, served the Lutheran Church as his career, but wanted to give back through the Moravian community because of the impact his education had early in life. So they donated a parcel of land, 45 acres of farmland. Foundation ended up selling that. The proceeds of that land sale is what funded their donor advised fund. And they had a very specific goal to try to fund education in other countries, but they wanted English-speaking children to be the beneficiaries of that. So that was kind of interesting to me. And as I unpacked it, it was because those donors wanted to travel and be able to see their money being spent and communicate with the children that were impacted through their grants. And they got to do that many, many times. Unfortunately, the gentleman passed away during COVID. His wife is still very much with us, but that's a neat story. Also had the example of a longtime employee who got a package at his employer. He was kind of let go early, bridge out to retirement. Because of the package, he got an influx of cash when he retired. So they wanted to offset the taxes on that by creating a donor advised fund. Again, they're giving to their church regularly, giving to other organizations. So they created a donor advised fund to do that. And we've also had these accounts created in honor or in memory of someone, and usually in that person's name by the family, and they make grants for years to come in that person's memory or honor. A lot of different ways to do these. Donor advised funds can be repositories for wedding gifts, memorials. When somebody enters the Lord's more immediate presence, you really have a lot of flexibility with a donor advised fund to use these in many, many ways. And I think anybody that's giving regularly to charity should seriously consider a donor advised fund. So the next tool is named funds. And what are they? Number one, there's a lot of buzzwords in our industry and terms that are thrown around. Named funds basically are any account that has a name tied to it, that has some sort of corpus it's awarding to charity. So that would mean any type of endowment, any scholarship, any designated fund for a specific cause. Field of interest fund, again, causes specific interests like hunger, thirst, housing, shelter, those kind of things would fall into the field of interest fund category. Those are named funds. So a lot of different uses of named funds, but again, same like donor advised fund, maximum benefit to charity here. This is a public charity donation, so you get the maximum benefit. You get flexibility in creation of this. Usually there's a governing document at the foundation. We help you develop that, actually do that for you. So it has your fingerprints on it throughout. MMFA serves as your trustee. So even when you're gone, you're in the Lord's presence, it is our job to make sure your wishes, your intent, your money that you've stewarded is used how you wanted it used in perpetuity into the future. We see a lot of use of this, especially because of that last bullet point. It allows for contingencies. If I leave money to my church and 50 years from now my church isn't in existence anymore, I still want my money used for XYZ. Who decides that? Again, you have to have a trustee in place, a fiduciary that can make those decisions as you would make them if you were still walking among the living. So it allows for that flexibility. These can be amended while you're still living. They can be funded in life or funded as part of a larger estate plan. They can also be the recipient of a donor advised fund. If you have a donor advised fund while you're living, you enter the Lord's more immediate presence, you can start one of these named funds with the proceeds of that to fulfill your charitable wishes and continue your charitable giving even after you're in the Lord's more immediate presence. So a lot of flexibility of this, a lot of named funds. We see these used a lot as well if people are naming multiple entities. Maybe you've got 4 organizations you're passionate about, but maybe you have a concern about 1 or 2 of them. And maybe it's either leadership or contingency planning. Is it going to be around forever? The named fund is a great selection for you, a great choice. Who should consider one? Again, it's kind of those last things. Are you paying multiple entities? Are you trying to pay an entity that maybe you're concerned about not being around forever? You would consider what are those named funds. Do you want flexibility? Do you want the maximum tax impact? Again, a named fund is a great opportunity for you. Legacy planning comes into that. I don't really see legacy in terms of name recognition. A big thing in the Moravian context. Most Moravians are very, very private with their giving, not concerned about a personal legacy or anything like that. So, but it is an opportunity for you to do that and create a named fund. Examples of named funds with MMFA, we've got a ton of these. I always like to tell Maxine Garrett's story. So Maxine was a banker in Washington, D.C., member of Faith Moravian Church. She was frustrated with the amount of debt that her church had to take on, very concerned about that, wanted to create a plan to help with that debt. She established a fund when she sold her primary residence. As she got older, she downsized, and she used part of the proceeds from her house sale to create a fund for her church. The neat thing about this story is it was created in the early 2000s. The fund has already given away more than she gave to it as its corpus. And the value today is about twice what it was when she contributed to it. So it's an amazing story. Her church has benefited wildly from her gift. And when this money is invested, these gifts benefit of compounding interest, up stock markets, the corpus grows, and often the story is like that of Miss Garrett's. It gives away far more than was funded originally. It grows, and often that organization is getting 2, 3, 4 times as what the donor thought they would get originally. So it's really a beautiful way to grow over time. I also had the opportunity to work with a gentleman who was going in for major surgery that was concerned. He wanted to do a fund to honor he and his wife. It was part of his estate plan. The fund was the beneficiary of his will. That gentleman didn't survive that surgery. So it was a wonderful miracle. We got the fund created before then and a way to really honor what he and his wife wanted to see done. His wife had passed many years earlier, and they left the residuary of their estate. So the balance of their estate went into this fund that had been created and benefits 4 different organizations today for different causes. Wonderful gift, wonderful opportunity, wonderful use of a named fund. Now, shifting gears a little bit, we're going to talk about charitable trusts. Charitable trusts are the only type of gift we're talking about today that pays an income stream back to individuals. So these are charitable trusts are part of a group of gifts called split interest gifts. Split interest meaning an individual is benefiting. There's some kind of individual beneficiary in there, and the other interests for charity. So charitable trusts are used a lot just with retirement planning, estate planning, and other types of needs, but usually because somebody somewhere needs an income stream back off that money during their lifetime. The flow chart on the screen in front of you, this is a 78-year-old. We picked on Jane's sample. Her name's not on here. Fictitious person, but it shows an illustration of $1 million gift for a 78-year-old and what that would look like over their lifespan. So if they're 78, the first year's payment's $50,000. They're donating $1 million. If they live 20 years, they're going to more than get back in income distributions what they put in originally. And you could see that the balance of this fund at the end is projected to be almost $1.5 million. So almost 50% more than the original amount contributed. This example tells us there was a $250,000 basis. That tells us she's contributing some kind of appreciated property, could be real estate, could be stocks, bonds, etc., something that's appreciated. So there's capital gain locked into the trust. Again, shouldn't have to pay that capital gain. She's donated the money. So what happens is the gain gets paid over time as the individual beneficiaries take distributions from the trust. So the distributions from the trust are not tax-free. They're taxed in their original character as they pass out, but the beneficiary certainly gets to take that income deduction at the beginning. So again, $750,000 of gains that don't have to be paid all up front. You see the income tax deduction, $646,000. It's important to note with a charitable income tax deduction, you don't have to take that all in year one. The tax code gives you a 5-year carryover, so you really have a total of 6 years to fully use a charitable income tax deduction, because that deduction is controlled by virtue of your adjusted gross income. I'm going way into the weeds with this, but you get 6 years to use it. I have, in my career, rarely encountered a donor that couldn't fully utilize the deduction, because you have 6 years to fully utilize it. So that's not an issue. If you say, well, it's great, Chris, I get a $646,000 deduction, but my AGI is only $100,000, $150,000. Well, you would have carry forward that you would get to use the deduction. So it is possible. Benefits of a charitable trust, the income stream for donors, other beneficiaries. Again, I'm seeing this used a lot with children. Because of the change in the IRA rules, families can't stretch IRAs anymore for future generations. Someone other than your spouse is going to have to withdraw that IRA within 10 years, pay full income tax on those distributions. This is a way to shield that. You can still shove that out over the donor or the beneficiary's lifetime and hedge that. They won't pay the capital gains at once. They'll pay it more over time, making your children's tax liability a little easier and help them not have to pay all that tax at once. You're also investing that money into a trust. So over the child's lifetime, there's certainly a great percentage of opportunity that they'll get more than the balance of the IRA in trust payments to them over their lifetime. Plus, at the end of your children's life, that corpus passes to the charities you've named in the trust document to get the residuary benefit of the trust. Great opportunity with IRAs. We're seeing that used more and more to pass those types of assets to children. You get diversification of your portfolio, particularly as part of a larger estate plan. If you have a huge concentration in stocks or certain assets, maybe you've got to own a lot of real estate, maybe you're asset rich, liquidity poor. This helps with that and diversifies your portfolio because the trust is in a segregated account. It's invested for you in a variety of assets. Again, the tax deduction, like on the example we looked at, you're deferring tax. You're not avoiding it totally. There's still tax on the payments as they're received and passed out, but it defers that. You don't have to pay it all up front. And then your charitable goals are fulfilled through the remainder beneficiaries. You're naming charitable remaindermen that get the balance when the life beneficiaries pass into the Lord's presence. You can also do these trusts over a term of years. They don't always have to be over a lifetime. Just the term of years can't exceed 20. That's charitable trust. So who should do one? Who should consider one? Basically, those that want an income stream. Think about this being done as retirement planning sometimes. The best example, I worked with a client once that was an editor. Her husband had a big corporate job as well. They contributed to this during their working years with the hopes that it would provide retirement income for them in their retirement years. Great opportunity for that, great use of this tool as well. It's also a great opportunity for somebody that has a low yielding or low basis, no income producing asset that they want to turn into an income producing asset. If you have that stock that doesn't pay a single dividend, you can put it in a trust like this and you're going to turn it into something that pays you guaranteed over your lifetime. And again, retirement assets for non-spouse beneficiaries, we talked about that, using the IRA to fund it for your children so they don't have to pay all that tax up front. Assets, most assets can be donated to a charitable trust. There's some limit with closely held stocks. S corporations can't be given to a charitable trust, but for the most part, if you can donate it, a charitable trust can take it and move forward with it. MMFA examples of charitable trust. We had a donor this year donate rental property to a charitable trust that he just didn't want to manage anymore or deal with, and then the rental property gradually being sold will create that corpus of that trust that will pay he and his wife over their lifetimes. Now, they used a specific type of charitable trust, which is called a flip CRT. You'll see that on this slide, flips. So there are different types of charitable trusts. There are those that pay a straight percentage, those that pay income. Older people qualify for that annuity trust to pay that fixed rate over time. We see unit trust used a lot more where it's a percentage based on the ending year value every year. So it revalues every year. If the trust grows, beneficiaries get paid more. The flip trust pays net income until an event happens that turns the trust into a straight fixed percentage payout. So the example of the real estate donation, the rental property, that's a flip CRT. So while we own real estate, it's paying net income. When all the properties sell, it flips and will be a straight charitable remainder trust and pay out 5% of the balance to the beneficiaries over their lifetime. So that's a great use. The flip is a great tool to use for that retirement planning too. Maybe you're not getting payments during your income producing years, but you have it flip when you retirement. The flip date has to be something out of the donor's control, out of the beneficiary's control, but again, a neat tool to use. Another example like this is we did have a donor and spouse create a trust for each child this year, and their plan is to fund those trusts at their death with their IRA assets. So again, that example of using it for retirement funding for children, great example of those tools. I have certainly talked a lot. I'm going